The financial markets operate in defined phases, cycles orchestrated by large informed interests. The vast majority of retail traders fail because they mistake random noise for structural change, or they attempt to fight the inevitable flow of the dominant trend. The key to consistent market performance lies not in predicting the future, but in accurately identifying the current phase of the cycle and aligning trading activity with the campaign of the composite operator. Understanding the structure of these cycles and the foundational laws that govern them is the essential first step toward professional trading. Before continuing, please subscribe and leave a quick comment, even one word. This small action helps the algorithm show this content to more people. The composite operator, a conceptual entity representing the largest professional money managers and institutions, executes their campaigns through 4 distinct stages. These stages define the entire life cycle of a securities price movement. Understanding this cycle provides the necessary framework for recognizing when a low-risk trade opportunity is forming and when the risk of holding a position becomes prohibitively high. The first stage is accumulation. This is the period where the composite operator quietly and methodically buys inventory, absorbing supply from the weak hands who are selling due to pessimism or discouragement. This phase is typically characterized by horizontal, choppy price action and the gradual drying up of selling pressure. The goal of the professional is to acquire a large position at the lowest possible average cost without driving the price up prematurely. The accumulation phase is a critical, often lengthy period of preparation, where the foundation for the subsequent advance is laid. Price movements within this phase are often designed to confuse the public, shaking out the last remaining sellers through minor declines and testing the willingness of the market to absorb supply. The second stage is markup. Once the composite operator has accumulated the desired inventory and the supply has been thoroughly tested and absorbed, the price is allowed to move higher. This is the trending phase, characterized by strong advances, higher highs, and higher lows. This is the period where the public eventually enters the market, driven by optimism and the fear of missing out, providing the necessary liquidity for the professional to eventually sell their holdings. The markup phase is where the effort expended during accumulation finally yields significant results, and the trend becomes visibly established, attracting widespread media and public attention. The professional trader seeks to participate fully in this phase, capitalizing on the sustained institutional demand. The third stage is distribution. This phase mirrors accumulation, but in reverse. Here, the composite operator systematically sells their inventory into the rising demand created by the public. Prices move sideways, often exhibiting volatility in large swings designed to keep the public engaged in buying. The goal is to unload the position at the highest possible average price before the trend reverses. Distribution ranges often show signs of increasing volatility and heavy volume, especially on upward movements, as the professional is actively supplying stock to the eager public. This stage represents the final stage of the professional campaign, where profits are realized and liquidity is provided by the last wave of optimistic buyers. The final stage is markdown. Once the distribution is complete and demand has been exhausted, the price begins its inevitable descent. This is the downtrending phase, characterized by lower highs and lower lows. Selling pressure overwhelms buying interest, and the market moves toward the next potential area of accumulation. During the markdown, pessimism increases, and the weak holders who bought near the top are forced to sell, fueling the decline. These 4 phases, accumulation, markup, distribution, and markdown, are continuous and repetitive, forming the essential rhythm of the market cycle that professional analysis seeks to exploit. The entire structure of market movement is governed by the law of supply and demand. This is the foundational principle upon which all other market analysis rests. Wyckoff observed that price changes are merely the visual manifestation of the imbalance between these 2 fundamental forces. Understanding this law requires recognizing that prices do not move simply because of news or sentiment, but because the practical imbalance between buyers and sellers dictates the direction. When demand exceeds supply, buying pressure is dominant, and the price must rise to attract sellers. This dynamic is clearly visible during the markup phase, where strong institutional demand pushes the security to progressively higher levels. The market must increase the price to find enough willing sellers to satisfy the aggressive buying interest. In this scenario, the volume of transactions, the effort, is heavily skewed toward the buy side, confirming the strength of the underlying trend. Conversely, when supply exceeds demand, selling pressure is dominant, and the price must fall to attract buyers. This condition defines the markdown phase. Sellers are eager to liquidate their holdings, and the price must drop significantly to incentivize new buying interest to step in. The volume of transactions will reflect heavy selling, often characterized by sharp declines on high volume as professionals liquidate and retail holders panic. Crucially, when supply and demand are in relative balance, the price moves sideways, forming a trading range. This horizontal movement represents a period of either accumulation or distribution, where the composite operator is actively absorbing or releasing inventory without triggering a major trend reversal immediately. The analysis of supply and demand requires careful attention to trading volume, as volume represents the effort behind the price movement. High volume on a price advance signifies strong demand, while high volume on a price decline signifies strong supply. The successful trader does not rely on subjective feelings about the market. They rely on the objective evidence provided by the relationship between the price movement and the transactional volume. The market is always seeking equilibrium, and the price movement is the mechanism through which that equilibrium is tested and reestablished. The professional seeks to enter the market just as the imbalance is shifting decisively in the desired direction. The law of cause and effect provides the essential framework for setting realistic price objectives. This law states that every market movement or effect must be preceded by a period of preparation, the cause. In Wyckoff analysis, the cause is the horizontal trading range, the period of accumulation or distribution. The effect is the subsequent vertical movement, the ensuing markup or markdown phase. The significance of this law is profound. The duration and amplitude of the horizontal trading range determine the potential extent of the subsequent trend. The market does not move vertically without sufficient preparation horizontally. A long, well-developed period of accumulation suggests a substantial amount of institutional buying has occurred, implying that the resulting markup phase will likely be long and significant. The extended time spent within the trading range allows the composite operator to build a massive position, which requires an equally massive trend to liquidate profitably. A short or narrow trading range, conversely, suggests a smaller amount of inventory has been exchanged, leading to a potentially shorter or less volatile trend. The cause must be proportionate to the effect. If a stock doubles in price, the professional trader knows that a substantial period of accumulation must have preceded that move. If no such accumulation phase is evident, the move is often viewed with skepticism, potentially indicating a temporary spike rather than a sustained trend backed by institutional capital. The composite operator spends significant time building their position during the cause phase. This time spent absorbing supply provides the necessary fuel for the subsequent price advance. The larger the reservoir of capital committed during the horizontal phase, the greater the pressure applied to the market once the trend begins. Professional analysis attempts to measure the extent of the cause, usually by counting the units of price movement within the trading range to project a minimum target for the effect. This measurement ensures that the projected profit potential justifies the risk taken during the entry phase. Without a measurable cause, any projected effect is merely speculation. The market must earn its trend through the hard work of the composite operator absorbing supply or releasing inventory. The third fundamental principle is the law of effort versus result. This law serves as the critical tool for detecting imbalances, weakness, or strength within the market that are not immediately obvious from price action alone. It compares the trading volume, which is the effort expended by the composite operator, against the resulting price movement. The result. This law is the market's internal warning system, alerting the informed observer to changes in the underlying institutional activity. When effort and result are congruent, the current trend is likely to continue. For example, during a strong markup phase, high volume effort should lead to significant price advances, result. Each new wave of buying is confirmed by strong transactional volume, demonstrating that institutional interest is aligned with the current direction. This congruence confirms the health and sustainability of the trend. Conversely, during a strong markdown, high volume should accompany sharp price declines, confirming that heavy selling pressure is driving the market lower. The most critical application of this law, however, is detecting divergence. Divergence occurs when the effort expended does not produce the expected result, signaling an imminent change in character. This non-confirmation is the professional trader's early signal to prepare for a major shift in the market cycle. Consider a situation where the price moves to a new high, perhaps even penetrating the old resistance level. But the trading volume supporting that move is noticeably lower than the volume on previous rallies. High effort is applied, but the result, the upward movement, is weak or unconvincing. This divergence indicates that professional money is no longer supporting the advance, suggesting that supply is quietly entering the market and absorbing the remaining demand. The composite operator is no longer aggressively buying, and the lack of institutional interest means the rally is likely to fail. This is an early warning of potential distribution. Conversely, during a markdown phase, if the price drops sharply, result, but the volume, effort, is extremely low, it suggests that the selling is not being driven by deep institutional commitment, but rather by panicked retail selling. This lack of effort on the decline suggests that the selling pressure is weak and may soon be exhausted, signaling potential accumulation. The price is falling because of a lack of buyers, not because of overwhelming professional supply. The professional trader constantly monitors the relationship between volume and price. They are seeking non-confirmation where the action of the price contradicts the underlying strength or weakness indicated by the transactional activity. This analysis provides the crucial advantage of identifying the shift in character before the general public recognizes that the trend has changed. The inability of price to advance on increasing volume, or the failure of price to decline on increasing volume, are the most reliable indicators that the composite operator is reversing their campaign and that the current phase of the market cycle is nearing its end. These three laws, supply and demand, cause and effect, and effort versus result, form the theoretical bedrock necessary to navigate the complexities of the market cycle successfully. The next step is applying these laws to identify the specific characteristics of accumulation and distribution. The process of accumulation is the professional phase where the composite operator quietly and methodically buys inventory. This phase is characterized by a trading range where price volatility is initially high but begins to contract as the process matures. The challenge for the professional trader is to distinguish genuine accumulation, which will lead to a significant markup, from a mere reaction within a continuing bearish trend. Identifying accumulation relies heavily on applying the law of effort versus result and the law of supply and demand, specifically through the analysis of trading volume. During the early stages, following a major decline, the market experiences a selling climax, often marked by extremely high volume and wide price spreads. This high volume indicates massive selling by the public, but simultaneously, significant absorption by the professional interests. The immediate relief rally following the selling climax is known as the automatic reaction. The market then tests the low of the selling climax, resulting in the secondary test. It is the character of this secondary test that provides the first crucial clue regarding the nature of the trading range. If the range is truly accumulation, the volume on the secondary test must be noticeably lower than the volume seen during the selling climax. The diminishing volume on the retest of the low is critical because it demonstrates that the supply, which drove the initial panic, has dried up. The effort of the sellers is no longer producing the result of new lower prices. This observation confirms the law of effort versus result is signaling absorption. As the accumulation phase progresses, the professional trader looks for further evidence of supply being soaked up. This often takes the form of multiple tests of the lower boundary of the trading range. Each subsequent test should ideally show lower volume than the last, confirming that the weak hands have been effectively shaken out and the composite operator has acquired the necessary inventory. Conversely, when the price moves upward within the accumulating range, the character of the volume should change. Upward movements should be accompanied by increasing trading volume and wider price spreads. These rallies, particularly those that clear minor resistance levels, are known as signs of strength. The high volume on the upward moves demonstrates that the professional buying is assertive and effective, overcoming what little selling pressure remains. The hallmark of mature accumulation is the final shakeout, often called the spring. This is a deliberate maneuver by the composite operator to drive the price momentarily below the established support of the trading range, trapping late short sellers and frightening out the last remaining weak longs. A true spring is characterized by a quick reversal back into the trading range, usually closing near the high of the day, and most importantly, occurring on relatively low volume compared to the initial selling climax. The low volume confirms that the move down was a test, not a genuine resumption of the decline, because there was no significant supply left to hit the market. Once the accumulation is complete, the market is primed for the markup phase. The cause, represented by the horizontal trading range, has been built, and the effect, the vertical trend, is imminent. Analyzing distribution is essentially the mirror image of accumulation. Distribution occurs after a prolonged advance, where the composite operator seeks to offload accumulated inventory at favorable prices into the hands of the public, who are typically optimistic and eager to buy. The start of distribution is often signaled by a buying climax, a sharp advance characterized by extremely high volume and wide price spreads. This move is fueled by public enthusiasm and aggressive buying, which provides the necessary liquidity for the professional to begin selling large blocks of stock. Immediately following the buying climax is the automatic reaction, a sharp decline that sets the lower boundary of the distribution trading range. The subsequent rally, the secondary test, is crucial. If this rally fails to reach the high of the buying climax and occurs on diminishing trading volume, it suggests that professional selling pressure is stifling demand. During distribution, the professional utilizes high-volume rallies to sell into the perceived strength. The market might repeatedly test the upper boundary of the range. Moves above previous highs that quickly fail, known as an upthrust or an upthrust after distribution, are classic maneuvers. These upthrusts are designed to lure breakout traders into long positions, just as the composite operator is completing their selling campaign. The law of effort versus result is critical during this phase. The trader observes that near the top of the range, significant effort, high volume, on upward attempts is producing less and less upward result, smaller price gains or immediate reversals. This divergence signals that the supply being introduced by the professional is overwhelming the existing demand. The professional selling pressure is becoming dominant. As the distribution range matures, the price action often becomes weaker. Downward movements start to penetrate minor support levels with increasing trading volume, while upward movements become sluggish and unable to hold their gains. The trading volume on downward reactions begins to increase, confirming the presence of professional selling. The completion of distribution leads directly to the markdown phase. The horizontal cause has been established and the market is preparing for the vertical decline. The entire purpose of identifying both accumulation and distribution is to position the professional trader on the correct side of the impending vertical movement. Trading against the cycle during these transitional phases is the primary cause of failure for novice traders. The transition from the horizontal trading range to the vertical trend is marked by a clear change in character. This change in character is the undeniable signal that the composite operator has finished their preparatory work and is ready to initiate the markup or markdown phase. Recognizing this moment is paramount because it offers the lowest risk, highest reward entry opportunity. In the case of accumulation, the decisive move is the sign of strength. This is a powerful, high-volume rally that decisively clears the upper boundary of the accumulation trading range. It is not merely an upthrust that fails, it is a sustained breakout, often accompanied by a dramatic increase in the volume of transactions. The sign of strength confirms that the composite operator is no longer absorbing supply, but is now aggressively demanding stock, pushing the price upward. The previous resistance levels have been broken, and the market structure has fundamentally shifted from sideways absorption to aggressive trending. Following the sign of strength, the market often returns to test the breakout level, turning the former resistance into new support. This reaction is called the last point of support. A valid last point of support must occur on significantly lower trading volume and exhibit tight price spreads, confirming that the professional interests are now supporting the price at the higher level, and that there is little remaining supply to halt the advance. Conversely, in distribution, the critical signal is the sign of weakness. This is a decisive high-volume break below the established support of the distribution trading range. The sign of weakness signifies that the professional selling pressure has finally overwhelmed all remaining demand, causing the price to fall through the lower boundary, often referred to as breaking the ice. Just as with accumulation, the market frequently attempts a rally back to the broken support level after the sign of weakness. This reaction is known as the last point of supply. For this to be a reliable signal, the rally must fail to penetrate the broken support, and it must occur on low or diminishing volume, confirming that demand has vanished and the professional interests are ready to press the decline. The recognition of the change in character is the practical application of the law of supply and demand in its most dramatic form. Supply has decisively overcome demand, or demand has decisively overcome supply. This structural break provides the confidence necessary for the professional trader to commit capital in anticipation of the trend phase. Once the trading range is identified and the change in character has occurred, the professional trader must determine the potential extent of the ensuing trend. This is the practical application of the law of cause and effect. The horizontal cause, the period of accumulation or distribution, must determine the magnitude of the vertical effect, the subsequent markup or markdown. To quantify this relationship, Wyckoff developed the horizontal point and figure counting method. This technique translates the time and duration of the trading range into a measurable price target. The methodology provides an objective roadmap for profit-taking, ensuring that the trader does not exit prematurely or hold a position past its intended target range. The point and figure chart simplifies price action by removing time and only plotting price reversals based on a predetermined box size and reversal requirement. During the accumulation or distribution phase, the trader counts the number of columns across the widest part of the trading range. Each column represents a unit of cause being built. The calculation of the minimum target requires multiplying the total number of columns counted by the value of the point and figure box size and the reversal setting used in the chart construction. This calculation yields the projected distance the price is likely to travel once the trend begins. For example, if a 3-box reversal point and figure chart with a $1 box size shows 40 columns in the accumulation range, the minimum count projection would be 40 columns multiplied by 3, the reversal setting, resulting in a $120 price projection added to the breakout level. This provides a quantifiable target derived directly from the effort expended during the horizontal phase. It is crucial to understand that the point and figure count provides a minimum expectation. The count represents the energy built up by the composite operator during the cause phase. By quantifying the horizontal action, the trader transforms a subjective assessment of market strength into an objective calculation of potential reward. There are typically two approaches to counting the cause. The conservative approach counts only the columns that occur after the last major test of the low in accumulation or the high in distribution, focusing on the core structure before the breakout. The aggressive approach counts all columns from the initial selling climax or buying climax onward, providing a maximum potential target. Professional traders use both conservative and aggressive counts to establish a target zone. This zone acts as a guide for managing the position and planning the exit strategy during the markup or markdown. Reaching the initial target zone often signals that the majority of the cause has been expended and the current trend may be nearing its end, prompting the trader to tighten stops and prepare for the next trading range. The consistent application of the point and figure count reinforces the discipline of the professional trader, preventing emotional decisions regarding profit-taking. The count provides the necessary confidence to hold a position through minor reactions during the trend, knowing that the structural energy of the trading range has not yet been fully discharged. The analysis of accumulation and distribution, coupled with the precision of point and figure targeting, completes the technical foundation required for successful cycle trading. The ability to identify the change in character and project the effect ensures that the trader is aligned with the composite operator's campaign. The next stage involves the tactical execution, identifying precise low-risk entry points and managing the position throughout the trend, using the advanced analysis of volume and price divergence. This transition from macro-cycle analysis to micro-entry technique is where the theoretical understanding of the three Wyckoff laws translates directly into profitable action. The first critical step in translating theory into action involves identifying the highest probability entry point, often found during the secondary test of the trading range. Trading the secondary test represents a low-risk, high-reward opportunity for the professional trader. It occurs after the initial volatility of the preliminary support or preliminary supply, and the dramatic price reversal of the selling climax or buying climax. The purpose of the secondary test is for the composite operator to gauge the remaining supply or demand near the boundary of the newly formed trading range. In an accumulation schematic, the secondary test checks whether new supply is still aggressively entering the market following the intense selling pressure that created the selling climax. If the test is successful, the price will hold above or near the low of the selling climax, and crucially, the downward movement will occur on significantly reduced trading volume and narrow price spreads. This confirms that the selling pressure has been largely absorbed by the composite operator. The secondary test provides an excellent tactical entry point because the protective stop-loss can be placed tightly just below the low established by the selling climax. The risk is clearly defined and minimal relative to the potential reward of the ensuing markup phase. Entering here requires patience, as the market often appears weak and uncertain during this phase, tempting many inexperienced traders to initiate short positions prematurely. Conversely, in a distribution schematic, the secondary test occurs after the buying climax. It checks for the remaining pockets of demand. A successful secondary test in distribution will show a failure to penetrate the high of the buying climax, characterized by low volume and narrow spreads on the attempted rally. This indicates that the composite operator is meeting little resistance in pushing the price lower, and that the market is ready for the markdown phase. The stop loss for a short position entered here is placed just above the high of the buying climax, again offering a favorable risk-reward ratio. It is essential to distinguish the secondary test from later, larger reactions within the trading range. The secondary test typically occurs relatively early in the range formation. Its primary function is confirming the initial boundaries of the cause that is being built. While the secondary test offers a low-risk entry, the professional trader does not commit substantial capital until the market provides clear confirmation that the accumulation phase is definitively over and the markup phase has begun. This confirmation is achieved by observing a decisive move past the established resistance of the trading range. In accumulation, this decisive move is known as the sign of strength. This is a powerful, high-volume surge that breaks through the upper boundary of the trading range, overcoming the final resistance that has capped price movement throughout the horizontal period. The sign of strength demonstrates that demand has finally overwhelmed supply and that the composite operator is ready to move the price significantly higher. The professional trader recognizes that breaking the range is often insufficient confirmation alone. The market frequently attempts a false breakout, known as an upthrust, which traps aggressive buyers. Therefore, the most reliable confirmation often comes from the subsequent action, the backup to the edge of the creek. The backup to the edge of the creek is a corrective move that returns the price back toward the upper boundary of the accumulation range, which has now transitioned from resistance to support. This pullback tests the sustainability of the breakout. If the price holds firm at the former resistance level on low volume, it confirms that the market structure has shifted. The retest proves that the supply that previously dominated that level has been exhausted. This is often the final, safest opportunity to commit capital before the main markup trend accelerates. Waiting for the backup to the edge of the creek requires rigorous discipline. The market may appear to be running away during the sign of strength, tempting the trader to chase the price. However, patience ensures that the entry is made only after the market has confirmed the institutional commitment to the new trend direction. This deliberate approach fundamentally separates the business of trading from the gamble of speculation. The inverse confirmation occurs during the transition from distribution to markdown. After a decisive break below the support of the distribution trading range, a movement known as the sign of weakness, the price will often return to the underside of that broken support line. This is the last point of supply before the main decline. A successful test at this level, showing renewed selling pressure and a failure to re-enter the trading range, confirms the commitment to the markdown phase. The most critical mistake a developing trader can make is initiating positions against the direction of the established cycle. This fundamental error is trading against the composite operator. The danger of trading against the cycle is not merely that the trade might fail, but that the probability of failure is structurally high, turning an analytical endeavor into pure chance. When the market has clearly broken support and entered the markdown phase, characterized by sharp drops and weak rallies, initiating a long position is inherently dangerous. The law of supply and demand dictates that supply is dominating and the path of least resistance is down. Attempts to buy the dip during an established markdown phase are often attempts to catch a falling knife. These attempts typically result in immediate losses or drawdowns that violate sound capital preservation principles. Similarly, initiating a short position late in the established markup phase, particularly after multiple signs of strength have occurred, runs counter to the prevailing institutional intent. The composite operator is still managing inventory to the upside, and shorting into strong demand is a high-risk endeavor. The danger is amplified by psychological factors. Public traders are often drawn into the market by major news events or emotional attachment to a stock near the end of a trend. They buy near the top of distribution, fueled by optimism, or they short near the bottom of accumulation, driven by fear and panic selling. The professional trader, utilizing the Wyckoff method, avoids this trap by judging the market solely by its own action, the price and volume, and ignoring external noise. Trading against the cycle violates the law of cause and effect. If a massive cause, accumulation, has been built, the resulting effect, markup, will be significant and sustained. Attempting to reverse a powerful effect prematurely before a new large cause, distribution, has been fully developed is akin to standing in front of a freight train. The ability to recognize when a trend is exhausting itself, and thus when to exit an established position, is the mark of an advanced technical analyst. This skill relies heavily on the detailed application of the law of effort versus result. During a sustained markup phase, the composite operator must continuously exert effort, volume, to overcome supply and push the price higher. Result: as the trend matures and reaches its potential price targets derived from the point and figure count, the professional trader begins to look for divergences between the effort expended and the result achieved. A classic warning sign of trend exhaustion is when the price continues to make higher highs, but the accompanying trading volume begins to diminish dramatically. This divergence signifies that the buying effort is weakening. The result, a higher price, is being achieved on less participation, indicating that the institutional support required to sustain the trend is waning. The market is becoming thin, vulnerable to a sudden reversal or the start of a new distribution phase. This analysis is also applied to the price spread. If the price makes a new high, but the daily or weekly price spread is noticeably narrower than previous rallies, it suggests that the effort to push the price higher is meeting increased resistance. The result is small, despite potentially high volume, signaling that the supply is aggressively entering the market at these elevated levels. This is often the first clear signal that the composite operator is unloading inventory. The professional trader uses these divergences in effort versus result to manage their exit strategy proactively, rather than waiting for an obvious reversal. If the divergence is strong, the trader tightens the protective stop loss significantly, ensuring that profits accumulated during the markup phase are preserved. Alternatively, the professional may liquidate a portion or all of the position, anticipating the high probability of the trend terminating and the market entering a new horizontal trading range. The same principle applies during the markdown phase. If the market is making lower lows, result, but the selling volume, effort, is consistently declining, it suggests that the supply is drying up. The market is weakening, but the necessary selling pressure to sustain the decline is absent. When a sharp downward move occurs, but the volume is conspicuously light, it suggests the composite operator is no longer aggressively shorting, and the decline is merely being driven by residual fear among the public. This divergence signals that accumulation may soon begin. The rigorous application of the law of effort versus result provides the final layer of technical protection, allowing the trader to exit near the peak of a move with calculated precision, avoiding the common mistake of giving back substantial profits during the inevitable correction. Successful application of the three Wyckoff laws, supply and demand, cause and effect, and effort versus result, requires not only technical proficiency, but profound psychological discipline. The methodology insists that trading must be approached as a serious business endeavor, governed by strict rules of capital preservation and risk management. The necessity of defining risk through mandatory stop losses, the refusal to chase prices, and the absolute avoidance of the fatal error of averaging down on losing positions are foundational pillars of this business approach. This disciplined mindset is precisely what separates consistent profit generation from market speculation. Richard Wyckoff, one of the most influential market operators of early 20th century Wall Street, left behind a work that shapes not just a trading method, but an entire philosophy of market behavior. In How I Trade and Invest in Stocks and Bonds, presented here in the Max Davidson adaptation, Wyckoff reveals the core principles that define professional trading. Discipline, self-control, reading the market through price and volume, recognizing the actions of large operators, rejecting news-driven noise, protecting capital above all, and planning full trading campaigns rather than isolated trades. Although the book does not contain modern Wyckoff terminology such as Phase B, secondary test, or the latest schematics of accumulation and distribution, these concepts grew directly out of the foundational ideas that Wyckoff explains. This work stands as the primary source of his market logic, a text essential for any trader who seeks to understand the roots of the Wyckoff method and build a disciplined, objective, professional approach to trading. A link to this foundational text for the professional trader is provided in the description below.